Imagine two families. Same city, same income, same mortgage payment. Then the economy crashes. 6 months later, one family is still getting approved for credit cards, refinancing their mortgage, and receiving polite emails from their bank asking if they need financial assistance. The other family can't get a small personal loan. Their credit limit is cut, their business line of credit disappears overnight, even though neither family has missed a payment. It looks random. It isn't. Behind every recession is a quiet sorting machine. Most people never see it. They only feel the consequences after the decision has already been made. Banks don't simply ask one question during a recession, who owes us money? They ask something much colder. If things get worse, who is most likely to survive? And the answer often has surprisingly little to do with your income, your job title, or even your credit score. Because when fear enters the financial system, banks stop behaving like salespeople. They start behaving like survivalists. That hidden shift changes almost everything. Every recession creates two different economies, the one people talk about and the one banks quietly prepare for months before everyone else notices. That's because banks don't wait for recessions, they anticipate them. Long before layoffs make headlines or stock markets begin falling, banks start collecting tiny signals. More customers carrying balances instead of paying them off, businesses borrowing just a little more than usual, mortgage applications slowing, late payments increasing by fractions of a percent. None of these signals mean much by themselves. Together, they're like smoke before a fire. Banks have one advantage most people don't. They can see millions of financial lives at the same time. Imagine trying to predict tomorrow's weather by looking out your window. Now imagine owning satellites. That's roughly the difference. And once enough warning signs appear, priorities change. Growth becomes secondary. Survival becomes everything. Here's where the hidden rule begins. Most people think banks lend money based on how trustworthy someone appears. That's only part of the story. Banks actually lend money based on probabilities. Every loan is essentially a bet, not on whether someone deserves money, but on whether they'll still be standing years from now. During good times, banks are willing to make riskier bets because losses are relatively small and profits are plentiful. But recessions completely rewrite the equation. Suddenly, every dollar loaned carries more danger. One default no longer looks like one default, it looks like the first domino. So, banks tighten standards. That's the part everyone knows. What most people don't know is how they decide exactly who gets filtered out. It isn't one magic number, it's layers of invisible scoring. Income stability, debt ratios, cash reserves, industry risk, employment history, geographic exposure, past borrowing behavior, even how often people use their available credit. Each factor adds another clue, not about who you are today, but about who you're likely to become under pressure. Notice the difference. Banks aren't measuring your present, they're estimating your future. That sounds impossible, yet modern banking is built around predicting uncertainty. Think of it like insurance. Insurance companies don't know whose house will burn down. They calculate probabilities. Banks do the same thing with borrowers, except during recessions, those probabilities change incredibly fast. An airline pilot and a software engineer might have identical salaries. During certain recessions, one becomes dramatically riskier than the other. Not because either person changed, because the economy around them did. Risk is never just personal, it's environmental. Now here's where things become uncomfortable. Many people believe paying every bill on time guarantees access to credit. Not necessarily. Imagine you're lending your own money to a friend. Friend A always pays you back. Friend B also always pays you back. Then both tell you they've just lost half their income. Would you lend them the same amount tomorrow? Probably not. Nothing about their history changed, only your expectation of their future. Banks think exactly this way, except they do it with algorithms running across millions of accounts simultaneously. Sometimes entire categories of borrowers become less attractive overnight.
Construction workers, restaurant owners, commercial real estate investors, small manufacturers. The bank isn't punishing them, it's reducing exposure. That distinction matters because it explains why perfectly responsible people suddenly hear the same sentence during recessions. "We've reviewed your account." Those four words often signal that a machine has already made a decision. Credit limits shrink, loan renewals disappear, applications receive polite rejections. From the customer's perspective, nothing happened. From the bank's perspective, the probability curve shifted. This creates one of the strangest ironies in finance. The people who most need credit during recessions are often the least likely to receive it. It's a financial umbrella, available when the sun is shining, harder to find once it starts raining. Banks know this sounds unfair, but fairness isn't their operating system. Risk management is. And that brings us to something even bigger: capital. Every bank must maintain enough capital to absorb losses. Think of capital as the bank's shock absorber. The more dangerous the economy becomes, the more valuable that cushion becomes. Regulators monitor it, investors watch it, executives lose sleep over it. Because if enough loans fail at once, the bank itself can become vulnerable. History is full of examples. The global financial crisis wasn't simply about people missing mortgage payments. It became a chain reaction. Bad loans weakened banks, weak banks reduced lending slowed businesses, slower businesses laid off workers, more layoffs created even more bad loans, a vicious circle. Banks remember that lesson better than almost anyone, which explains another hidden rule. During recessions, banks aren't only evaluating customers, they're evaluating themselves. Every loan they approve affects how much risk they're carrying tomorrow. Sometimes saying no protects the institution, even if saying yes would help the customer. That's an uncomfortable trade-off, but it's one the system was designed to make. Here's another misconception. Many people assume the richest borrowers automatically receive unlimited access to credit. Not always. Banks don't necessarily love wealth, they love resilience. There's a difference. Someone earning $500,000 with enormous debts can appear riskier than someone earning $100,000 with substantial savings and modest obligations. Cash matters, liquidity matters, flexibility matters. When uncertainty rises, resilience becomes more valuable than appearances. That's why recessions expose financial structures people never noticed during boom years. Who has emergency savings? Who depends entirely on monthly income? Who owns assets that can actually be sold? Who owes money on everything? The recession doesn't create these differences, it reveals them. Like lowering the tide, suddenly everyone sees which boats were leaking all along. Now zoom out, because this isn't just about individual borrowers. The same hidden rule applies to businesses. Large corporations often secure financing while smaller competitors struggle. Not necessarily because they're better businesses, because banks believe they have more ways to survive. Diversified revenue, cash reserves, access to investors, international operations. One company looks fragile, the other looks adaptable. Again, probability, not certainty. This is why recessions frequently make large companies even larger. The strongest balance sheets gain access to capital precisely when everyone else is losing it. Opportunities become cheaper, competitors disappear, assets sell at discounts. History shows this pattern again and again. The strongest players often emerge stronger, not because recessions are good for them, because credit remains available. And credit during a downturn can become more valuable than profit itself. This creates a quiet feedback loop. Access to money increases your chances of surviving. Surviving increases banks' confidence in lending you more money, which further increases your chances of surviving. The opposite loop can be devastating. Lose access to credit, miss opportunities, reduce income, appear riskier, lose even more access. Neither loop begins with morality. It begins with perceived resilience. That's the hidden rule. Banks aren't primarily asking whether you're successful. They're asking whether you're statistically difficult to kill financially. It's a remarkably cold question, but from their perspective, it's rational. The uncomfortable part is that most people only discover where they stand after conditions have already changed. By then, the decision isn't being debated. It's already embedded inside thousands of models, stress tests, and risk calculations running quietly in the background. So the next time someone says banks stopped lending because they're greedy or because they're scared, the reality is more complicated. Fear matters, profit matters, regulations matter, but underneath all of it sits a simple calculation. Who is most likely to survive long enough to pay us back? That calculation quietly shapes recessions long before headlines catch up. And it raises one final question. If banks are constantly measuring resilience before a crisis arrives, how many people only discover their true financial position
After someone else's algorithm has already made up its mind?